Bitcoin is not simply falling because of one bad headline, one weak trading session, or one short-term wave of fear. What is happening now is more important than that. Bitcoin is being tested by liquidity, and the market is asking a very direct question. When price moves lower, is there still enough real demand willing to step in? That question matters because Bitcoin's strongest periods are rarely built on price alone. They are built on flows, confidence, and a clear reason for capital to choose Bitcoin over everything else in the market. When liquidity is expanding, when risk appetite is strong, and when investors believe Bitcoin has a powerful role in the next market cycle, weakness can be bought quickly. But when liquidity becomes more selective, the same price drop can feel very different. It stops being only a dip and becomes a test of demand. Right now, Bitcoin is facing that kind of test. The long-term story has not disappeared. Bitcoin is still a scarce asset. It is still part of the institutional conversation. It is still connected to the broader debate about money, liquidity, inflation, and financial trust. But markets do not reward a long-term story every day. In the short term, markets reward the asset that receives the next dollar of capital. And at this moment, Bitcoin is not clearly winning that fight. The first pressure point is ETF flow. The spot Bitcoin ETF story was one of the biggest structural changes in this cycle because it made Bitcoin easier for traditional investors to access. It created a cleaner bridge between Wall Street capital and crypto exposure. When ETF inflows were strong, the message was simple. Institutional demand was supporting the market. But when that flow weakens, the same structure can work in reverse. Outflows do not mean the entire Bitcoin thesis is broken, but they do show that the marginal buyer is less aggressive than before. That is important because price does not need every investor to sell in order to move lower. It only needs new demand to become weaker than new supply. If ETF buyers slow down, if some institutions reduce exposure, and if traders become more cautious, Bitcoin can lose momentum even while long-term holders remain calm. This is why the flow data matters more than social media emotion. The market is not asking who believes in Bitcoin forever. It is asking who is buying Bitcoin right now. The second pressure point is capital rotation. Bitcoin is not competing in an empty market. It is competing against artificial intelligence, megacap technology, bonds, cash, the US dollar, and every other asset that can attract capital in a cautious environment. When investors feel confident, they may have room to own many risk assets at the same time. But when they become selective, they start choosing the story that looks strongest, clearest, and easiest to justify. At the moment, artificial intelligence still has that powerful market story. AI connects chips, data centers, cloud spending, energy demand, software, productivity, and corporate earnings. It gives investors a broad and familiar framework. They can look at revenue, capital expenditure, supply chains, and company guidance. That does not mean AI is risk-free. Expectations are high, valuations are sensitive, and any disappointment can create sharp selling. But even with those risks, AI still has a near-term earnings narrative that Bitcoin does not always have. Bitcoin's value proposition is different. It is not based on quarterly earnings. It is based on scarcity, network belief, monetary demand, adoption, and liquidity conditions. That can be very powerful when the market wants a macro asset with upside and optionality. But when investors are cautious, Bitcoin needs stronger confirmation. It needs flows to support the story. It needs market structure to prove that buyers are stepping in. It needs macro conditions to stop working against risk assets. This is why the current weakness should not be read in a simple way. It is not enough to say Bitcoin is dead. That is too emotional. It is also not enough to say this is only a normal dip. That may be too casual. A better description is this: Bitcoin is waiting for liquidity to choose it again. That waiting period is uncomfortable because Bitcoin can remain important while still not leading. It can remain a long-term asset while still losing short-term momentum. It can still have believers while new buyers hesitate. This is the difference between a strong thesis and a strong market structure. A thesis explains why an asset should matter. Market structure shows whether capital is actually acting on that thesis today. The third pressure point is macro timing. Bitcoin is entering a period where investors are watching inflation data, Federal Reserve expectations, the dollar, yields, and the broader risk environment. This matters because Bitcoin often behaves like a liquidity-sensitive asset. When markets believe liquidity will improve, Bitcoin can respond quickly. When markets fear tighter conditions, sticky inflation, higher for longer interest rates, or a stronger dollar, Bitcoin can struggle even if there is no major crypto-specific disaster. That is why Bitcoin can look heavy without one dramatic event causing the move. Sometimes the market does not need a new bearish story. Sometimes it only needs the absence of a strong bullish catalyst. If ETF flows are negative, if macro data is uncertain, and if capital is more attracted to AI and megacap technology, Bitcoin can stay trapped below pressure while everyone waits for a clearer signal. The key issue is confirmation. Bitcoin does not need a miracle to recover, but it does need evidence. It needs evidence that ETF outflows are slowing. It needs evidence that buyers are defending important levels. It needs evidence that macro pressure is not getting worse. It needs evidence that capital is willing to move back into crypto instead of staying concentrated in other parts of the market. Without that evidence, every bounce can become fragile. A green candle may create hope, but hope is not the same as demand. A short-term rally can happen from oversold conditions, short covering, or temporary relief. But a stronger recovery requires something deeper. It requires buyers who are willing to absorb supply and hold the market above key zones. It requires flow to improve, not just sentiment. This is where many traders make a mistake. They look only at price and try to decide whether Bitcoin is bullish or bearish from one move. But price is the final output. The better question is, what is happening underneath the price? Are ETF flows improving or getting worse? Is spot demand returning, or is the move driven mostly by leverage? Are stablecoins moving back into risk, or are they still waiting on the sidelines? Is the dollar helping risk assets or making conditions tighter? Are yields easing or keeping pressure on speculative markets? These questions matter because Bitcoin is not just a chart. Bitcoin is a liquidity asset, a sentiment asset, and a macro-sensitive asset all at the same time. That makes it powerful during expansion, but vulnerable during hesitation. When the market is confident, Bitcoin can move faster than almost anything else. When the market is uncertain, Bitcoin can also expose exactly where demand is missing. So the real story is not that Bitcoin is finished. It is that Bitcoin is in a demand test while capital is being pulled in different directions. On one side, Bitcoin has scarcity, institutional access, and long-term macro relevance. On the other side, it has ETF outflows, cautious investors, AI competition, and a macro calendar that may keep risk appetite on hold. That creates a very specific market condition. Bitcoin is not being ignored, but it is also not being aggressively defended. It is not outside the market's attention, but it is no longer the cleanest risk story. It is still a major asset, but it needs fresh liquidity to prove that the next leg of demand is real. For the calm metrics, the clean framework is simple. First, watch ETF flows, because they show whether institutional demand is stabilizing or still leaving. Second, watch Bitcoin's reaction around key levels, because support only matters if buyers actually defend it. Third, watch macro conditions, because Bitcoin needs a friendlier liquidity backdrop to rebuild momentum. Fourth, watch capital rotation, because if AI and megacap technology continue to attract most of the market's attention, Bitcoin may need an even stronger catalyst to lead again. The most important part is not to turn this into panic. A liquidity test is not the same as a final breakdown. Bitcoin has gone through many periods where the market questioned demand before the next major move developed. But it is also not wise to ignore the warning signs. When flows weaken and capital rotates elsewhere, the market is telling us that confidence is not automatic. It has to be earned again. That is the calm way to read the current environment, not with hype, not with fear, and not with blind conviction. Bitcoin is under pressure because liquidity is selective. If that liquidity returns, the market can change quickly. If it does not, Bitcoin may spend more time trapped while other assets absorb the available capital. The next signal will not come from a slogan. It will come from behavior. Do ETF outflows slow down? Do buyers defend the market with strength? Does macro data reduce pressure on risk assets? Does capital stop rotating away from Bitcoin? If those answers begin to improve, Bitcoin can rebuild its structure. If they do not, the liquidity battle continues. So the core message is this: Bitcoin does not need everyone to become bullish overnight. It needs the flow picture to stop getting worse. It needs capital to see a reason to return. And it needs the market to prove that this is demand absorption, not just temporary support. Until then, Bitcoin is not simply falling. It is waiting for liquidity to choose it again.